Hello there and welcome to Finance Teacher. This video is the third one in the series that discusses dual currency deposits or dual currency investments. We discussed the basics in the first video and the payoffs in the two common scenarios in the second video. You can head over there if you want to understand those aspects. In this video, we will discuss DCDs in some scenarios where the issuer takes wrong decisions. Normally, the issuer will not take such decisions. These scenarios are discussed just to clarify the risk and return calculations and understand a bit more about DCDs. Understanding the calculation helps one understand why the issuer will always stick to the two scenarios discussed in the previous video on scenario analysis. Let's get going. To refresh, this is a GBP USD dual currency deposit. The investment currency is GBP 1 million. Interest per annum is 8% and the maturity is 90 days and the year has to be taken as 360 days. The principal plus interest in the investment currency GBP is 1.02 million at maturity and the strike or conversion rate is 1.27. In this scenario that we are discussing, scenario 3, the bank invests the money in GBP and the repayment is also done in GBP. The spot rate at maturity is 1.3, which is above the strike rate. Now, normally, a bank would repay the maturity amount in the alternate currency USD because the spot rate at maturity is above the strike rate or the conversion rate. However, the bank mistakenly chooses to repay the investor in the investment currency GBP despite the fact that the GBP has appreciated. In this case, the bank will simply repay the investor GBP 1.02 million without taking advantage of the appreciation. The bank's return is GBP 1 million into 1.02 minus GBP 1 million into 1.02, which is 0. Basically, the bank's maturity amount is paid to the investor, leading to 0 return for the bank. The investor's return will be the amount received from the bank minus the initial investment, which is GBP 1 million into 1.02 minus GBP 1 million, which is equal to GBP 20,000. Basically, the bank has forgone the GBP 23538 profit it could have made by buying the USD amount at 1.30, which is the spot rate at the time of maturity. Quickly, we can recap this. USD repayment is equal to USD 1.02 million into 1.27, 1.27 being the conversion rate, which is basically equal to USD 1.2954 million. To get this much USD amount, the bank needs to spend GBP 1.2954 million divided by 1.3, which is GBP 996,462. Since the bank got GBP 1.02 million from its investment, the bank could have made a profit of GBP 1.02 million minus GBP 996,462, which is GBP 23538. Also note that a higher appreciation will not help the bank or the investor in this scenario because the bank has chosen to pay in GBP instead of the logical payment in USD. This scenario clearly proves that the bank will always pay the investor in the alternate currency if the investment currency strengthens beyond the strike price. Let's look at scenario 4. Here, the bank invests the money received from the investor in GBP. The repayment to the investor is done in US dollars, despite the fact that the spot rate is less than the strike at maturity. The spot rate on maturity is 1.23. That is, the investment currency has depreciated. The bank still chooses to pay the maturity amount in USD, which is the alternate currency. Normally, you would expect the bank to pay in the investment currency in such a scenario. Recall that GBP 1.02 million or USD 1.2954 million are the only two choices for the bank. This time the bank chooses to pay USD 1.2954 million instead of the GBP 1.02 million you would expect. Note that the bank invested the GBP 1 million and got GBP 1.02 million. To pay USD 1.2954 million to the investor, it will need to buy USD 1.2954 million at the spot rate of 1.23. This will cost the bank USD 1.2954 million divided by 1.23, which is equal to GBP 1053171. Therefore, instead of paying GBP 1.02 million and settling its liability of the contract, the bank will have to in fact pay GBP 1.053171 million. The depreciation is equal to 1.23 minus 1.27 divided by 1.23. That is, the GBP depreciated by 3.25%. Now the loss for the bank in such a scenario is GBP 1 million into 1.02 minus GBP 1 million into 1.02 into 1.27 divided by 1.23, which is equal to GBP 1 million into 1 plus 2% into minus 3.25%, which is equal to GBP 33171. Therefore, the bank bears the 3.25 depreciation of the investment currency on the principal and the interest, resulting in an effective depreciation of minus 3.25% into 1.02, which is equal to 3.3171%. The depreciation gets magnified and the bank loses a lot of money. The investor's profit loss can be calculated as follows. The investor's profit loss in GBP is equal to the amount received from the bank minus the initial investment. Basically, the investor gets GBP 1.2954 million divided by 1.23, which is 1.053171 million, and his initial investment amount was GBP 1 million. Therefore, he makes a profit of GBP 53,171. Note that the bank loses exactly 33,171 and the investor gets a bounty of GBP 53,171. In effect, the bank passes the GBP 20,000 return it earned on its GBP deposit to the investor. In addition, the investor earns GBP 33171 because of the depreciation of the investment currency and the interest. Now the alternate currency in which the investor has been paid is worth much more than the GBP 1.02 million because of the depreciation of the investment currency. In this scenario, the more the depreciation of the investment currency beyond the conversion rate, the higher the loss for the bank and the higher the profit for the investor. Basically, repaying in the USD is detrimental for the bank if the investment currency depreciates to such an extent. This is why normally the bank would pay in GBP. The investor would not get the benefit of this depreciation of the investment currency. In the scenarios discussed, the bank invests the money in GBP. Therefore, we have calculated the depreciation or the appreciation of the investment currency or the alternate currency with respect to the strike price and not the initial spot price. Because the amount was invested in GBP, not in USD, the initial spot price is not mathematically relevant in the given context. In the next 4 scenarios, we presume that the bank will convert the initial GBP deposit received from the investor into USD and invest the USD amount in an 8% per annum deposit. Let's discuss scenario 5. Here the bank invests the money in USD. Basically, it receives 1 million pounds from the investor and it converts the 1 million pounds into $1.25 million based on the initial spot rate of 1.25, and the $1.25 million are invested at 8% per annum. The maturity is 90 days. The years taken as 360. The strike rate is 1.27 as in all scenarios, and the spot rate at maturity is 1.23, and in this scenario the bank repays in the pound. In this scenario, the bank receives the USD maturity amount of 1.275 million from its USD deposit, converts it into GBP 1.036585 million at 1.23, which is the spot rate at maturity. Out of this amount of GBP 1.036585 million, it pays GBP 1.02 million to the investor, and the balance is his profit. The investment currency GBP depreciates beyond the strike price. The bank benefits because it parked the funds in USD at 1.25, which was the initial spot price, and the USD appreciated by 1.626% with respect to the initial spot price. The appreciation is calculated as follows: 1.25 minus 1.23 divided by 1.23, which is equal to 1.626%. The bank benefits from the 1.626% appreciation of the principal and the 2% interest in USD terms. Therefore, the bank gains 1.626% into 1 plus 2%, which is equal to 1.6585%. The GBP equivalent of the gain for the bank is 1.6585% into GBP 1 million, which is equal to GBP 16585. Mathematically, this is the same as the bank's maturity amount in GBP minus the amount paid to the investor in GBP, which is GBP 1 million into 1.25 into 1.02 divided by 1.23 minus GBP 1 million into 1.02, which is equal to GBP 1 million into 1.6585%, which is GBP 16585. Basically, bank gets the benefit of the appreciation of the USD because it pays the investor the agreed GBP 1.02 million amount only. For the investor, the gain is simply GBP 1.02 million, which it receives from the bank, minus the GBP 1 million which it invested, which is GBP 20,000. Note that the sum of the profit and or losses of the two parties is not equal to GBP 20,000 where the bank invests the initial GBP 1 million after converting it into USD. Both the bank and the investor are happy when the bank invests the money in USD, repays in GBP, and the investment currency weakens. What happens if the investment currency strengthens? The party will be over for the bank. That's why the bank will not convert the GBP to USD initially. The conversion entails significant unnecessary risk for the bank. Note that the more the depreciation of the investment currency GBP, the higher the profit for the bank. However, the profit for the investor will remain fixed at GBP 20,000 because it will always get GBP 1.02 million at maturity. Let's discuss scenario 6. In this scenario, the bank invests the money in USD and the repayment is also done in USD. This scenario is exactly as the previous scenario except for the fact that the bank repays the investor in USD. The bank converts the GBP 1 million to USD 1.25 million initially, deposits the USD 1.25 million, earns 2% interest on it, leading to a maturity amount for the bank of USD 1.275 million. The bank buys the USD equivalent of GBP 1.02 million required to pay the investor at the spot rate of 1.23. Therefore, the cost for the bank is USD 1.2546 million. The bank's profit is USD 1.275 million minus USD 1.2546 million, which is equal to USD 20,400. In GBP terms, this is going to be 20,400 divided by 1.23, which is GBP 16585. For the investor, the gain is simply GBP 1.02 million minus GBP 1 million, which is GBP 20,000. Note that the more the depreciation of the investment currency GBP, the higher the profit for the bank. However, the profit for the investor will remain fixed at 20,000. Let's look at scenario 7. Here the bank invests the money in USD and the repayment is in USD, but this time the spot rate at maturity is 1.3, which is above the strike rate. To recap, in this scenario, the bank converts the GBP 1 million received from the investor to US dollars at the spot rate of 1.25, invests the USD 1.25 million for 8% per annum or 2% interest in 90 days. In the process, the bank gets USD 1 million into 1.25 into 1.02, which is USD 1.275 million. The bank decides to repay the investor the maturity amount of GBP 1.02 million in US dollars. As we know, the equivalent USD amount is to be calculated at the strike rate of 1.27. And the amount works out to be USD 1.2954 million, which is GBP 1.02 million into 1.27. Therefore, the bank gets the maturity amount of 1.275 million and pays 1.2954 million US dollars to the investor, resulting in a loss for the bank. The bank's loss is USD 1.275 million minus USD 1.2954 million, which is USD 20,400. In GBP terms, this is 20,400 divided by 1.3, which is the prevailing spot rate on maturity. Therefore, the bank's loss is GBP 15692. Mathematically, this can be seen as GBP 1 million into 1.02 into 1.25 minus GBP 1 million into 1.02 into 1.27, and this difference has to be divided by 1.3 to calculate the GBP amount. This works out to GBP 15692. Basically, the bank lost money because it invested the money in USD at GBP USD 1.25, but the conversion rate was 1.27. It lost in USD terms on both the principal and the interest. Accordingly, the denominator of 1.3 converts the USD loss to GBP. Therefore, while the bank's USD loss remains fixed because of the initial spot price and the strike price being known, the GBP loss will decline if the GBP keeps appreciating. This is because while 1.25 minus 1.27 is fixed, any increase in the denominator, say from 1.3 to 1.31, will reduce the GBP amount. The investor gets USD 1.2954 million, which is worth GBP 1.2954 million divided by 1.3, which is GBP 996462. Therefore, the investor's loss is GBP 996462, the amount it got from the bank in GBP terms, minus GBP 1 million, which is the amount which the investor put in, which is GBP 3538. Mathematically, this can be seen as GBP 1 million into 1.02 into 1.27 divided by 1.3 minus GBP 1 million. If you simplify, this comes to GBP 1 million into 1.02 into 1.27 minus 1.3 divided by 1.3, resulting in a loss of GBP 3538. The investor gets the benefit of the interest earned, but loses money because the USD amount is worth much less in GBP terms. Now, if the investment currency appreciates further, the investor's loss increases significantly. Therefore, this is a peculiar scenario where both parties lose. The bank's loss will slowly decrease as the investment currency GBP appreciates further, and the investor's loss will increase significantly in the same situation. Let's discuss scenario 8. Here the bank invests the money in USD and the repayment is done in GBP. However, the spot rate on maturity is 1.3, which is above the strike rate. Here the bank converts the GBP 1 million received from the investor into USD 1.25 million at the initial spot rate, invests the USD 1.25 million at 8% per annum, and gets USD 1.275 million on the maturity date. On the maturity date, the spot rate is greater than the strike price, which means that the GBP has appreciated. The bank decides to pay the investor GBP 1.02 million instead of the USD 1.02 million into 1.27, which is USD 1.2954 million. The bank invests in the USD and the GBP appreciates by 1.3 minus 1.25 divided by 1.3, which is 3.8462% from its purchase price, the initial spot price. The bank bears this appreciation cost of the principal and the 2% return. Therefore, the total appreciation is 3.8462% into 1.02, which is 3.9231%. Basically, the bank gets USD 1.275 million on the maturity date. This amount is worth GBP 1.275 million divided by 1.3, which is equal to GBP 980,769. Now, the bank needs to pay the investor GBP 1.02 million. Therefore, the bank's loss is GBP 980,769 minus GBP 1.02 million, which is GBP 39,231. Mathematically, this looks like this: GBP 1 million into 1.25 into 1.02 divided by 1.3 minus GBP 1 million into 1.02. If you simplify, this comes to GBP 1 million into 1.02 into 3.8462 with a minus sign, resulting in a loss of GBP 39231 for the bank. Alternatively, you can look at it as follows. The bank needs to spend USD 1.02 million into 1.3, which which is equal to USD 1.326 million to repay the GBP amount at maturity. And note that bank got only USD 1.275 million from its USD investment. Therefore, the bank will lose USD 1.275 million minus USD 1.326 million, which is USD 51,000, and at 1.3, this works out to be GBP 39231. For the investor, the gain is simply GBP 1.02 million minus GBP 1 million, which is GBP 20,000. In this scenario, the more the appreciation of the investment currency GBP, the higher the loss for the bank. The investor is not impacted by further appreciation of the GBP, and his min-max profit is £20,000. Again, the bank's loss plus the investor's gain is not GBP 20,000 because the bank invested the money in USD and took direct exposure of the GBP's appreciation by repaying the investor in GBP. As we can see from the scenarios, there is no fixed minimum return for the investor, and he can lose a significant amount of money in a dual currency deposit. And the maximum return for the investor is the promised yield. There is no minimum or maximum yield for the bank. The bank can make money if it invests the investor's deposit in GBP and earns a higher return than promised. Of course, if the investment currency strengthens, the bank can make a lot of money, especially if the investment currency's appreciation is significant beyond the conversion rate. Importantly, the best strategy for the bank is always invest the money received from the investor in the same currency as the investment currency. Do not convert to the alternate currency initially. Repay in the investment currency when the investment currency does not strengthen beyond the conversion price. And repay in the alternate currency when the investment currency strengthens beyond the conversion price. Any other strategy is too risky or surely doomed for failure. Here we end part 3 of our video series on DCDs. In part 4, we will discuss some variations of DCD structures. Thanks for watching.